If you had any type of long position in 2022, more than likely you got clapped. The markets have been relentless. However, right now we're going to be looking at an indicator that could possibly mark a bottom, the bottom, or might not even be useful to us at all. However, we're going to look in the history of the S&P 500 on the weekly time frame. Right now we're looking at TradingView and see how this line, the 200 week moving average, has held up in history. So each time we come to this 200 week moving average, which has only happened a total of 16 times since 1960. It's either broken through without any type of support, it's bounced off of, marking a bottom, or it was a bear market rally, which ultimately resulted in breaking of the 200 week moving average. So each time this happened, we're going to make a table of this. And I've already done this already. And basically, I'm going to go ahead and break it down to you. So we got all the dates on which these events have occurred. The first column is basically how long did it take for it to peak out and ultimately hit the 200 week moving average. The second column is how much was the drawdown from that ultimate peak to the 200 MA, excuse me. The third column was, did it break, bounce, and if it bounced, what type of bounce was it? Was it the actual bottom or was it a bear market rally, which is the fourth column? The fifth column is, if it was a bear market rally, what type of percent gain did we get out of it? And number six was, how long did this bear market rally last? And number six, part two, because obviously I can't count, is how much time did it spend under the 200 moving average, week moving average, that is, if it did break through it? And what type of percent drawdown do we see from the initial breakdown to the ultimate bottom underneath the 200 week moving average, which is column number 7. Column number 8 is, was this a recessionary period? Yes or no? And column number 9, if it bounced multiple times before ultimately breaking through the 200 moving average, how many times did it do that? And how long were in between each time? And the last column was, what was the total drawdown during this period from peak all the way down to the bottom? So with this data, I mean, there's a whole bunch of different things we could do with it. However, what I've looked at so far is basically identifying how many times have we bounced out of the total 16 times. So 4 times out of the 16 times we did not bounce, which I wrote it wrong in this document. But basically a 1/4 chance of it failing. And this is for a bear market rally and for a actual bottom. So 7 of the actual of these bounces were actually the bottom. 5 were bear market rallies, averaging about a 12.5% gain. The max was 15.5. The minimum was 10.5. And on average, they lasted about 11 weeks. The max was 17 weeks. The minimum was 4 weeks. Of those 4 times, it broke straight through. The average drawdown total was 20. The max was 37.5. The minimum was 10. And this is measuring from the 200 week moving average. So if you were to take a trade, this is the type of risk that you would be accepting. 10 out of the 16 times were actually recessions. So more often than not, if it did hit the 200 week moving average, it was a recession. And at the end of the day, if it was identified as one at that point, maybe it was, maybe it wasn't. Something also to keep a note of is that recession is no longer defined by 2 consecutive quarters of negative GDP growth, which is what many people are following at the moment. So if we were to get a second print in Q2 of 2022 as a negative, the media is going to eat that up. The markets are going to eat that up, and we're going to sell off, guys. That's not going to look good, because if we'd be in a technical recession, which again isn't an actual recession, but it's a technical. I forgot what the name of the bureau is, but they're the ones who are responsible for calling when a recession started and when a recession ended. But it's usually after it's happened, not whenever it first starts. The average total drawdown for all of these together, from top all the way down to the bottom, was 31% total. The max was 59.5%. The minimum was 11%. The most close situation economically to what we're experiencing today is the 1980s with respect to the inflation. They had a stagflation at that point in time. And what ended up happening is Paul Volcker ended up raising interest rates ridiculously by amounts in order to push the economy into a recession, and ultimately ended up hurting the U.S. economy, but we ended up stopping inflation. Now we're having inflation that's turning from transitory to secular. Some people believe it's secular, some people think it's transitory, but ultimately the Fed is having trouble trying to tame this inflation. So there's a problem with that, because the thing is that headline inflation is involving of the supply constraints, which the Fed can't control. It's the supply side. They can only control the demand side. So by them continuing to raise interest rates, it's hurting the U.S. economy because we keep shrinking and shrinking our demand, even though our demand is already controlled, which is shown in the core CPI. Right now, the 200-week MA on the SPY, not the SPX, but the actual SPY, is sitting in about 350. And I can actually pull up the chart at the moment. It's sitting about 350. So if we were to ultimately hit this 200-week moving average, we'd have to fall 8% from our current position, which is at 381-ish. And basically, it would be a total of negative 28% from the actual peak all the way down to the 200-week moving average. About, now, don't get too exact. This is a log on a log scale, just to let y'all know. But that's something to keep a note of. So with all this data and all this information, we could compare this to past times. One thing to keep in mind is how long did it take for if there was a period of time that it took longer than what we're currently experiencing, because we're about, 26 weeks in, 27 weeks in. The periods that have lasted longer than this is going to be the 6th longest time. And those other times, the 4 out of the 5 other ones, were actually recessionary periods. So if it's taken us this long in order to hit the 200-week moving average, it means we've been selling off slowly, more and more and more. The chances are we are going to head into a recession, if you look at it that way. The biggest drawdown that we've had since the peak all the way to the 200-week moving average is about negative 36%. Not for us. Ours is negative 28% at the current moment, but the one that's closest to it, that was actually more, was negative 36%, and that happened in 1987. The reason why we have such a big disparity between the actual all-time high as well as the 200-week moving average is because how much of a big bull run we had since COVID. So that's why that disparity is so big. But again, it's just important to keep in mind that recessionary periods have happened whenever we've lasted this long until we hit the 200-week moving average, which we actually haven't officially hit it yet. So that's something to keep in mind as well. And out of those 5 longest times after what we're in right now, so we're at 26 weeks currently. Any time that has lasted longer than that in order to hit the 200-week week moving average, 4 of the 5, again, were a recessionary period. And during those times, they've averaged about 42.4% drawdown. The max was 59.5%, and the minimum was 24%. So that's something to keep in mind, just because right now our situation is not looking too great. There's war, there's supply constraints still from COVID, there's supply constraints from Ukraine, Russia. Do you think that's still going to end anytime soon? Inflation is getting out of hand. The Fed is tightening insanely, and we're having negative growth within actual earnings of companies. At least their outlook has been changed for a majority of them. Some of them have had a negative growth print for the Q2 results, but now, or the Q1 results, I should say. And now we're looking at the Q2 results and Q3 for the new series of earnings reports. So that's something that helps to keep in mind. And there's a whole bunch of other things that you could look at as well, showing us that what we're heading into would be worse than what we're currently experiencing at the moment. So just know that there's a lot more fear in the moment, but there might be a bear market rally. So if that's you're a trader, that might be something that you want to look into. If you're a long-term position holder and you can't handle the pain that you're experiencing in the markets, you might want to hold on a little bit longer, as we could see a potential bounce that could give you a better position to exit your positions, and so on and so forth. Hopefully this information was useful. Y'all could double check me by looking at these numbers and looking at the calculations. Not only that, but you can actually go back into the data yourself. All you need is a TradingView account and look at the SPX symbol, as that is the index itself, the actual S&P 500. The SPY is an ETF that tracks the SPX, just to give you a little bit more information on that. But apart from that, guys, good luck with y'all's trading, and hopefully this video does help.